Welcome to the Foundation for the Study of Cycles FSC Financial Crisis Forum. And our big question today, as part of a live interactive expert panel discussion, near miss or eye of the storm. Today is May 9th, 2023, and I'm pleased to be welcoming a record-breaking sign-up. This is really amazing milestone, I think, for the foundation. We have actually broken 1,000 registries in just 10 days. So thank you so much for signing and attending, and we celebrate that record-breaking registration. So just to remind, FSC Financial Crisis Forum, near miss or eye of the storm. We have a live 6-hour immersion session.
I don't think it's going to be 6 hours, Ron.
Sorry, not 6 hours. 6 speakers, thank you.
2
speakers.
hours. Yeah, I don't want to get everybody freaked out.
Typo on my part. 6 hours if you want, but it's actually 2 hours. Pretty tight in terms of our on-point messaging, and we will save more time for the panel discussion, which we think would be the best value for this type of event that we're organizing today. Thank you so much for the correction, Richard.
Yeah.
Okay, so as a preview of the speakers and experts that you're going to hear from today, it's all our FSC team. Bill Sarubi, who actually presented online video, you would have seen that over the weekend, so we had some good engagement there on his presentation of the panic cycle. So I just hear from the team that Bill will hopefully be with us here at the back end of the session to join the panel discussion. So hopefully if we can be here together, we can share more voices. Lars von Thienen will actually lead live today, talking about the financial stress index cycles, followed by Andy Pancholi, how history repeats with mathematical precision, focusing on the anchor point in 1933, but I'm told that he will be looking at other historical rhymes and repetition patterns. Jake Bernstein, cycles, seasonality, protective strategies. Dr. Richard Smith, how to prepare for market volatility, and myself, Ron William, the roadmap cycle update, looking at the banking crisis and what it means from a cycle framework based on my approach, with a big focus on gold as a potential crisis hedge. Okay, so just a few brief words on the FSC. Membership privileges for the low yearly price of $150. Register for the financial summits for free. That is something we've been doing now for some time. At the start of each year, free access to our award-winning cycles detection app, and feel free to ask more questions later on today or during the weekly YouTube feature with Lars von Thienen. There will be a premium upgrade coming soon, and you would have already received messaging on that through our newsletter. Unlimited use of the cycles library, something that I encourage many of you to be using more of. And then finally, your membership dues support science summits as well. It is part of our mission charter to look at cycles both in markets, but also life and science. And so we feature that in Cycles Magazine, the Cycles newsletter, Cycles TV, and more. For further information, join today on the link below, and you should receive that in the YouTube chat. And of course, a big thank you to our members that contribute in many different ways. First and foremost, donations. Everything we do, including this Financial Crisis Forum, is made possible by generous donations from people like you. Keep in mind that these are tax deductible, and they do allow us to not only continue the work, but raise further awareness and build ideas and a greater community to study this work. For more information there, the link also will be shared on the YouTube chat. And just a final word on further good news ahead. So in addition with our Cycles app, we will be building an education initiative as part of a professional recognition for the study of cycles. And this will also allow us to align with influential cycles and market analysis societies and associations. So it should be a big tribute to the study of cycles, and of course, give many of us the opportunity to learn more and share our insights. Now, just brief house rules. Reminder to please send your questions, because we do want to really encourage you all to ask questions, to share your insights, particularly at the end of the session, which is 2 hours, not longer. So we will allow for time before then. We will get some Q&A after each of the sessions. So each session will be about 15 to 20 minutes or thereabouts. So we should have some time for brief questions then, and then at the very end during the panel discussion. So my first test question, as part of a survey, which I like to do each event: banking crisis, near miss, or eye of the storm, what do you, the FSC membership and audience, believe? So if you could just type which answer you currently stand by. You don't have to be 100% sure, just type in what you think is the more likely probability. And if possible, add your big context point as to why it's either a near miss or eye of the storm. I'll check the YouTube chat and review in the background before we follow to our leading speakers. But please, if you can share your feedback, insights, banking crisis, near miss, or eye of the storm. What do you think? Are you bull, bear? Are you concerned? If so, how much? And what do you think might be the consequences? Now, no further ado, I'll pass on to our leading, our first speaker, Lars von Thienen, who will be talking about the Financial Stress Index. Lars is the founder and CEO of a German-based knowledge management company, invented standalone desktop search and knowledge management app. Coding software since, he has been coding software since childhood. Von Thienen has supported leading German DAX companies in developing their digital and business strategies as a large-scale project and IT manager. He also develops algorithms and software for cycle recognition at when2trade.com and has published 2 books on cycles analysis. Appointed by the Minister of Justice, Von Thienen has been working as a commercial judge for over a decade. Von Thienen is based in Germany, and we greet him here at the back end of the evening. Welcome, Lars. Look forward to your presentation.
Hi, Ron. Nice to be part of it. So looking forward to a great session with you and the colleagues.
Thank you. Over to you.
Yeah, I mean, as we are the foundation for the study of cycles, let's kick it off with some cycles before we jump onto the banking system itself. And therefore, I want to start with some cycle analysis we did at the foundation almost 2 years ago with a very long-term cycle I shared at that time, and that cycle is related to the financial stress index. So, and if we talk about banking and banking crisis today and during these days, this is mostly related to financial stress, and therefore we have some data available, and that's what I'm using, or what I like to use, is the financial stress index, which is provided by the Federal Reserve banks in the US. I think almost every Federal Reserve bank, regional Fed publishes a kind of financial stress index. I like to use it from the Federal Reserve Bank of St. Louis. It's freely available. It's a weekly data series. And it's a composite they provide, I think, out of 10 to 12 different financial measures. So they measure different data sets related to the financial condition, and they give it a kind of composite value, which is then similar to measuring the financial stress out of these 10 to 13 individual measurements they take into account. They publish this once a week. They update this data once a week. And it's a perfect source to apply cycle analysis. First, I think because financial stress is moving slowly. Yeah. So financial stress will not jump around in huge portions one day and the other. And that's why it is kind of perfect data set for cycles. And seconds, it's quietly also aligned to sentiment. So it's a kind of measurement within the sentiment data set. So it's a great source of data to apply cycle analysis. So, and that just said up front, and I will show you the current status on this cycle for sure. But before going to the current situation, we need to repeat the procedure we did at the foundation. Just need to organize my screen here. During the last 2 years, and I need to start, I will go quickly through it. You see here August 9th, and I mean August 9th of the year of 2021. So this is this cycle analysis. It was live. We did it at the foundation. It's printed in our YouTube library. This was a real-time analysis, August 9th in the year of 2021. And my head is not as important, but just have a look at the cycle, which is shown here at that point in time. So this was the analysis. I need to just clear the coloring here. Give me a second. So here, that's the point of the analysis, yeah, in August 2021. And you see the blue data is the financial stress index, which I just explained. This was the year of 2008. This was where we had the banking crisis, 2007, 2008. You see this index peaked here at that point in time. And then we had the Corona crisis, which kicked in at that point in time here, was then the second large peak. And then if you just review from a cyclic perspective, that's if you follow the cycle, just aligning the tops and bottoms here at that point in time. And even you see this lower topping here, it quietly showed us the point in time when to expect highs and lows in this data set. I mean, that was the historical analysis, and we discovered the cycle of around 200 weeks here, yeah, which is shown by our cycle analyzer at that point here, which I just highlight. So let's call it a nominal cycle of 200 weeks. And I shared it at that point in time because this cycle was coming to a bottom. So financial stress bottoming at the end of the year of 2021, early 2023. That's why I highlighted that at this point in time, because these points in time are always interesting. And this financial stress, I'm sure you're aware of this, is inversely correlated to the equity markets. So if you see a high financial stress, this is corresponding with lows in the equity markets and vice versa. So if you have a low financial stress condition, this would then be the same as on top in the equity markets. So in August 2021, we see that by early 2022, late 2021, a low in financial stress. And how does financial stress unfold first? You see topping equity markets at that point in time. And I mean, we know what happened. Markets peaked, I think, early 2021, January, exactly predicted by this long-term cycle. But that's not the point we want to discuss today. So let's now move forward a little bit in time on this presentation here. Oops. I need to clear the annotation. Here. So that's a zoom in for this given point here. And as I said, in the first period, when you see this financial stress coming into the markets, that's when equity markets turns down. That's what we observed through the whole year of 2022. And now, and that's where we are today. We are now in this peaking area, early 2023, where we are arriving at the high point of this predicted financial stress. I mean, this prediction was 2021, predicting the financial stress coming into the late stages of this topping cycle here in 2023. So if you're a cycle analyst, I mean, we have been waiting for financial stress and this kind of banking crisis showing up now for 1.5 years. So this is no surprise if you do your homework as a cycle analyst with this financial stress. I mean, you don't know the exact event which will unfold, so you cannot define by a cycle about this specific event, like we have now the trouble in the regional banking. But that this will occur in early 2023 was seen, or at least shown, by this kind of cycle here. So that's the purpose of cycle analysis. So starting with cycle analysis now, setting off the discussion of this banking crisis, and are we now in the eye of a storm, or have we passed the worst already? You see that, I mean, in that old presentation here, the top for this financial stress was predicted for summer this year, but this is an outdated projection. Yeah, we can never use this kind of outdated 1.5 years old analysis. So we need to review if this cycle is still valid. So let's quickly now move forward in time. So this is the current situation, yeah, with the current analysis of the data set. So what you see here down below, we are using the same data set, but you see now from the blue data here, it was updated with the latest data here up to today. Yeah, so that was the point of the analysis I showed you. We have now more data from financial stress. And first, what we can observe is here, that's indicated by this green arrow here. Yes, financial stress, the financial stress index, as projected, has increased over time. I mean, very volatile, but you see it has moving up. Another very interesting observation, by the way, if you check this absolute reading here, we reached early March, I think this year. This value has only been seen during the Corona crisis, but not reached here. Not reached here. We only reached the level at that point in time during the financial banking crisis 2008. So this is a very rare situation, reaching that absolute value of the financial stress here, which we have seen early March. So this is already a very rare situation that we peaked, at least this interim peak, at that level. Yeah, we have not seen for almost 15 years. We have not seen that level for the past 15 years in financial stress showing up. Second, you see here on the top, I've updated the analysis based on the latest data. As cycles are a little bit dynamic, that's what I said, the analysis we did 2 years ago is outdated because cycles are dynamic. We're using dynamic time cycles. They can shift, they can vary in terms of phase, amplitude, and length. But you see the same cycle, more or less the same nominal cycle is here detected. So just the top shifted slightly now into late summer or summer this year. I mean, we can't derive the statics timing, but we are now approaching, and that's what we're discussing today, we are approaching a very interesting time window based on this cycle, because this cycle will reach its top this summer. So we now need to judge, okay, has this already been the topping peak? I mean, it could be left translated or right translated. You see here from past analysis now, so the real peak is sometimes more right translated, or here it is a little bit left translated. Here the peak is again left translated. So you never know exactly if it's a little bit more left or right translated, but at least we are approaching that window now. And that's now the question we need to try to answer. Has this already been the key peak? So then we could say, okay, we are now through the storm already, and maybe financial stress will now move down. Or do we expect the final peak maybe to come during the next 2 to 3 months? At least that's what the cycle projection here is showing us. And my takeaway for today on bottom line, and I will show you why in a second, we have not reached the final peak yet, and there are some clear indications which give you leading information what happens to financial stress right now, and I will share this finding in a second. A second indication is, I mean, we are now at this levels here prior to the real banking and financial crisis we had in 2008, which just kicked in after we reached that level. So if this kind of sentiment repeats, there should come a final push in financial stress. So that's this cycle, which is now very, very interesting to follow during the next weeks. The reason why I think we are ahead of this, so we are ahead of the storm, so we are not through yet, is just one additional data, and then I will stop this information sharing here. If you look at one measurement, which is an underlying measurement of this financial stress, is the Federal Home Loan Bank system, which is used not only by the regional bank, I think today by almost all financial institutions, to get money if they have liquidity problems. And this system has been established in 1932, so after the Great Depression. So it's interesting that this system was set up in 1932 to provide to the banking these advances here for financial conditions which get in trouble, which need quick liquidity out of the systems. And that's what the FHLB system is provided through today. And if you look at the money they provide to the banking system right now to help regional or even larger bank to get over their current problems in regards to liquidity. So if consumers move out their funding there, they need to quickly get the liquidity working. And if it's a little bit hidden, so this is not an official measurement. So this is a leading indicator before it really hits the official system here. And this was the value we have seen in the financial stress or the banking crisis 2008. And we have now reached, or we have passed that value. So we have the highest value we ever had at the end of the first quarter of this year. The Q1 value is not in the official FRED data set because you need to read the official publishing from the FHLB system. You can grab it from the webpage. They do announce the Q1 results there, but it's not audited yet. So it's not updated in the FRED database. It will show up in the FRED database, I think, in June, once this data has been audited. But if you draw in this number here, it has passed 1 trillion. It is even higher than 2007, 2008. It is not related to just 2 or 3 regional banks, which we might read in the financial media. Okay, just 2 or 3 smaller banks have now been in trouble and this have been solved out. No, if you read here the numbers of the advances which have been provided as liquidity measures to the financial system, and that's maybe my last sentence, the banking system stress already exceeds the previous extreme of 2008. That's the reason why I think we have not seen the end of this cycle. We are close now to this stress peaking up, and financial stress is still there, even higher than 2008, 2009. But that's my just opening of this session, showing the cycle and sharing these findings here with the group. So Ron, happy to discuss. Back to you.
Thank you, Lars. Fascinating as always, and we certainly, the FSC team, have been following the cycle model on the financial stress index as you've been highlighting it over time. And actually on that buzzword time, if we could maybe open the point about the timeline this year and potential cycle translations or leads and lags. You mentioned that would be an important area for us to focus on.
Yeah, I think now we need to move to maybe daily data sets and monitor the condition more closely on shorter time frames. I mean, that's the weekly time frame here. This provides us with a kind of window. Yeah, the window is now this summer. Now we need to fine tune to find out if we have the left or right translation. And for example, what we could use is volatility measurements. So the volatility index we might have, which is also a kind of indication on stress in this market environment. So I like to use, for example, the volatility, the VIX index, and cycles on that index to more fine tune when possible interim tops and bottoms on the daily time frame might be. This gives us a little additional conclusion on when we might arrive at the real top of this financial stress. So that's what I said. We can't set this in stone, but now you need to apply additional cycle analysis on additional data sets, which we can't do now in this 15 minutes. But I think this is then the topic to do for every analyst out there. Move down to similar data sets, which provides daily data, kind of like hidden information of this FHLB banking system information, which will show up in the media, I think 1 or 2 months lagging. But if you read the data and are able to interpret this information, you get a quick glimpse of what will show up and if it's solved or not.
And just a brief follow-up to that, Lars, we also have a separate question to close on, but a brief follow-up on that. On the long end of the cycle, so a potential peak during the summer, but does it also maybe suggest an ease in financial stress going into next year?
Yes, that's a good question. So thanks for raising that, because you can look now from 2 perspectives on this topping window. So if we are ahead of the top, it could look like we on the short next 2 months, we will get more stress in the system. But once we have passed it, maybe late summer, maybe late this year, we will see relief. Yeah, and this is then the sun comes out after it's raining, so better weather will come after this summer. So that's also the good part of the story. It does not to be negative at all. Maybe just we need to have one shower out there, but then afterwards maybe the sun is shining again. Correct?
Yes, absolutely. And I highlight that partly, I mean, based on the analysis that you share, but also knowing that there are diverse views that will be shared today from our team, highlighting their key insights, but of course, insights that may vary in terms of maybe direction or even the risks or opportunities that might follow. We have some questions which I think can be followed up maybe at the end or during the weekly sessions. A question on the technical nature of the FSC model. I'm sure you get that question regularly, Lars, in terms of how it's computed and so on. And then a question I think that will come up perhaps to the group on macro events that are coming as we speak. The US debt ceiling is one of the points that was just flagged by just now by one of our delegates.
Yeah, just 2 quick answers. I mean, the technical part is just we are using digital signal processing to detect those cycles. So the cycle was not drawn in by line because we think 200 weeks fit. This was detected by digital signal processing. This is what our members and we use regularly to deal with dynamic time cycles. That's how the 200-week cycle was brought up. And second, these macro events now, you can set them in context. So that's what I wanted to say. I mean, the cycle I shared does not give you a clue ahead of time what events will unfold. But if you now see these events unfolding from a cyclic perspective, you're not surprised, because this is exactly what the cycle kind of predicted, that at this point in time, you should be prepared. And that's what's the beauty of cycles. At least you're not surprised about these events. So you're kind of prepared in early 2023 that these kind of events could unfold. And it also does not mean that this will unfold, but at least it's just perfect. Yeah, okay, this is what we've seen 1.5 years ago. So you could be prepared. You have done your risk assessment just upfront. So you don't need to be in a rush now to make your risk assessments or your portfolio. So you could prepare. Once these events are now unfolding, you should have your risk management plan in place, your money management plan in place. You can react accordingly. You're not surprised.
Thank you very much, Lars. Positioning very clearly and the benefits of cycle analysis across different approaches, including macro, on that last question that was asked. Thank you very much. And following on from our leading presentation now, it'd be great to introduce Andy Pancholi, who will be discussing how history repeats with mathematical precision. Andy Pancholi is the creator of the Market Timing Report and is co-author of the bestseller 0 Hour and the Lost Coffee courses of W.D. Gann. He has extensive knowledge of the works of W.D. Gann, R.N. Elliott, J.M. Hurst, and numerous other forecasting techniques. Pancholi also specializes in geopolitical forecasting, the long-range forecasting of space weather, solar flares, CMEs, as well as earthquake prediction. He consults with some of the largest banks and institutions in the world and advises government bodies. Andy, welcome.
Thank you very much. It's an honor to be here. And let me just bring the slide deck up. Right. So thank you. Well, first of all, what we're going to talk about today is how history repeats with mathematical precision. And I'm going to reference it also to the 90-year cycle. And what we're going to do is, by the end of this presentation, you'll know how to forecast the longer term patterns, market cycles, but we're also going to drill it down into key timing windows. And I'm going to take it all the way down to an individual day or two. So that's what we're going to try and achieve. And what I want to start off with, really, the topic is banking crises. And pretty much every banking crisis tends to lead to a market crisis. Well, why? Because obviously the banking stocks get badly impacted, and that in itself brings the markets down. However, market crashes do not always involve banks, so we can get geopolitical events that create crashes. So the two different things, the two beasts here, two different beasts. One's one's banking crises, and the other's market crashes. So one always leads to the other, but it's not the other way around. Is the first key point to make. And with this in mind, we want to seek out the patterns that allow us to forecast what lies ahead. And the real secret to this is about super long-term cycles. It's about knowing where to look. Now, I brought some new information in. I know there's quite a few friends of our work, my work here. So I'm going to I've added some new stuff that I've just put together over the last week. And I'm also going to show you one of the techniques that we use in forecasting that I've never actually publicly spoken about. It's something just kept in the inner circle. So stay tuned and we'll show you some clear dates at the end of it. We'll show you how we drill hundreds of years of data down to a single day. And how do we do this? Well, we start off with this, my favorite thing that we keep in the office here, the crisis matrix, where so after the team, we've studied all sorts of different events and we put them in timelines. And through that, we discover a whole series of patterns. Now, as I say, some of this first part, some of you will have seen before, stay with it because I've added some bits and pieces to it. And what I need to do in order to explain where we are right now in 2023 and to assess what the risk is, both to the stock market and to the banking structure, we have to look at how these cycles work. So I'm just going to give you a very quick tour of super long-term cycles, just to show you, and you decide for yourself whether mathematical precision appears or not in long-term economic cycles. Let's start off with the 90-year cycle. It's very prolific in the commodity markets, and it also works in the stock market. Well, we're talking about stock markets today, so let's take the 1929 crash. You've all heard of that, and we're going to head back 90 years from there. But just as a recap, for those of you that are not aware, in 1929, the market made a top on the 3rd of September, 1929, at a price of 386. It then plummeted by 90% down here, making a low on the 7th of July, 1932. So bear that in mind. There's a big clue there. There was a major low in 1932, right? So that was just 91 years ago. As I say, the market was down 90%. But how did that crash occur in terms of mathematical time cycles? Well, if we go all the way back to 1837 to 1842, the United States had seen a massive boom based on cheap credit, specifically around the canal building around the Great Lakes. So commodities such as wheat, corn could be shipped out up through the Great Lakes, out of the St. Lawrence Seaway, across the world. So there was this massive boom around Chicago and so on, and that turned to bust. And it was also due to some of the policies of Andrew Jackson, the Second National Bank. We don't have time for that right now. But the point is, there was a very big top and a very big crash. The market came down 74%. So you can see how this 90-year cycle is repeating. Now, I'm going to come back to that, but the half cycle, and this is a very important point of this lecture, the half harmonic is 45 years. So if we take 1839 and add 45 years to it, we get to 1884. And we did see there a crash. It wasn't a huge crash, but it was basically a crash of around about 30%. And that was based on basically precious metals leaving America, specifically gold. So moving on from that, if we take 1929 and we add 45 years forward, so we went 45 years forward from the previous crash, or 45 back from 1929 was 1884, come back to 1929 and move forward 45 years, we then see the equity lows of the OPEC oil crisis. So some of you will remember this. I remember this well. I know you think I'm far too young, but unfortunately I do. Basically, the oil crisis there brought in this significant, this is a logarithmic chart, and that was exactly 45 years on from there. And moving forward, we were looking for a significant top in 2019, and that was just 6 weeks out. So over a 90-year cycle, 6 weeks is a very small tolerance. And of course, that came in mid-February 2020 with the arrival of the pandemic. So you can see how this cycle's unfolding. So where are we right now? Well, 90 years back from 2023 was 1933. And what happened? Well, during the first week of April 1933, there was a significant banking collapse. In fact, by the time it had all finished, over 4,000 American banks had collapsed, and the president had to. He was forced to declare a bank holiday of about a week. Okay, that was to stop other banks from collapsing. As a result of this, as a result of this, the FDIC was created, and it guaranteed people's deposits up to the sum of $2,000, which was a significant amount then back in 1933, later raised to $5,000 by the end of the year. So what happened during the first week of what happened March, April 2023, we saw the Silicon Valley Bank right on schedule hit the news. We saw issues with the Swiss banks, and we are still seeing issues with banks in America. There is still a degree of nervousness. So you can see that this particular 90-year cycle referenced to 1933 is repeating pretty much to within the week. And as the previous speaker, Lars, mentioned, already the government bailout this year has exceeded that of the global financial crisis in 2007. So I wanted to reference that to the 90-year cycle, but stay with me, there is more to come. Also, during the month of April, in fact, it started in March 1933, this executive order, actually it was issued on the 5th of April, was issued by the president, making everybody with gold holdings valued greater than $100 was forced to turn them in to the government, right? So, and I think they were paid, I think it was $25. And so this was some direct intervention, damaging the gold standard, obviously. And the government decided you had no option but to turn that bullion in. That was it. And that's the executive order there. That, and the cutoff date was the 1st of May. You had to have it in, and you were paid a nominal amount. Now, the Treasury were pretty smart or abusive, depending which way you want to look at it. They took that money in. They took that gold in at a certain price and then relaunched it at, I think, $32 an ounce. I think it is off the top of my head. So they immediately inflated the American reserves just like that by tampering with numbers. That sort of thing doesn't happen, does it? Stay with me. The next important cycle is the 100-year cycle, and I want you to pay particular attention to this. Just to show you why, well, the 2007 global financial crisis was exactly 100 years after the 1907 rich man's panic. We'll very quickly whiz through this. The half cycle is 50 years. We're going to be working with this in a couple of minutes from now. 1857, 1957, 1907, 2007, all saw crises. And during certainly 1907, 1857, and 2007, there were runs on banks. The Northern Rock Bank in Britain saw a significant run on it. So the next one in this sequence is, sorry, let's just run through these first, is basically 2007, global financial crisis. So masses of credit, CDOs, CDSs, and boom, the market came down 54%. 1907, the rich man's panic, also known as the Knickerbocker crisis. Again, credit suddenly dried up. And interestingly enough, JP Morgan was called upon by the, it wasn't the Federal Reserve then, that didn't come into 1912, 1913, but the government, the Treasury, to come and help with the crisis. And of course, JP Morgan was a prominent name 100 years later in the global financial crisis. But this crash was all about the withdrawal of credit. Go back another 100 years, and Europe is amidst the Napoleonic Wars. The United States thought they could influence this by passing the Embargo Act, which basically banned trade with the rest of the world. Effectively, they were hoping this would create blockades in Europe and it would help deflate the war situation. Unfortunately, it backfired, and that caused a massive stock market crash in America, and the market came down 90%. Now, the midpoints of this cycle, stay with me, you're doing well. I'm sorry if this is a bit mathematically complex, but I'm going to show you how we tie all this together with all these intertwining cycles in a moment. So 1957 was the 50-year cycle on from 1907 or back from 2007, and that saw a secular decline. This wasn't a crash per se. This was, I mean, certainly that's a crash pattern in terms of chart reading. But what we saw here was that every American that wanted a television, a motor car, a refrigerator could afford it, had now got one. So there was an end or a decrease in manufacturing in the manufacturing industries. So 1957, the market came down 20% and quite a sharp correction. So heading back from 1907 took us to 1857. Now, 1857 was the biggest banking failure to date when the Ohio Life Insurance Trust failed in Cincinnati, and it was all to do with the overissue of railroad bonds. But it didn't just happen in America. We were also getting something similar happening in Britain, so and Europe. So this was a global collapse in 1857. So this is quite an important point to make. Now, on the home run, and I've got to bring the cycle in because we're going to build on this one, the 72-year cycle, again, we'll start off, we'll look at this and I'll show you how this all strings together. But we'll use the 1929 crash point. And if we go forward from there, which I'll show you momentarily, we get to 2001, which was the end of the dot-com boom. It really ended in 2000. It was the end of that first, the NASDAQ bubble burst. But if we go back, and I'll show you again, 72 years from 1929, we get 1857. So did you see 1857 anywhere else? I hope you were paying attention. We just mentioned that a minute ago. So 1929, as mentioned before, 90% collapse. 1857, down 62%. So everybody that's into Fibonacci will know that that's a pretty hefty regular correct, well, not regular, but a very precise mathematical correction. Moving this forward, there's the dot-com boom and bust. By now, everybody had got the first tranche of mobile phones, I think, and what else? Fax had all been replaced, and I can't remember. It just seems like only yesterday, doesn't it? But the market there came down 40%, basically, after its top in 2000, 2001. So what's the next one in this series? 2001 plus 72 is 2073. Now, in other presentations, I'll say make a note of that and tell your grandkids. I'm not going to tell you that. I'm going to tell you to pay attention to the year 2073 right now. And here is why. So I've never shown this in public, and this is one of the tricks to forecasting. You have an anchor point, basically, and you look back into the future, and you seek confluence zones. So just like you saw now, if you were paying attention, that 1857 appeared in both the 50-year or the 100-year cycle and the 72-year cycle, there was a confluence. I'm going to show you how we can put things together exactly from this future point all the way in 2073. So the 2073 point was derived from the 72-year cycle pattern, and working back using the 100-year midpoints. Take 50 years off 2073. Where does that take us? Do the maths, folks. That takes us right now to 2023, right here, right now. Okay, so now we're reverse forecasting, we're reverse engineering, but it takes more than one cycle to create an event, and it doesn't even guarantee an event. It's just a potential window. So we need to look to see if we can validate this. So let's head back 50 years from right now, 2023, or 100 years from 2073, and that takes us to 1973. So 1973 is within 1 year of the 1974 midpoint that we talked about earlier, And in fact, that was 73 was the top as we came into the 74 bottom as the OPEC crisis built up. So you can now see a harmonic resonance developing in these mathematical patterns. So we started off at 2073. We projected back 50 years to now. We projected back to 1973 to the OPEC crisis, and we project another 50-year cycle back. It takes us to 1923. Let's have a look at 1923. Well, that's this area circled here. There it is in the inset box, and it was quite a significant correction. But if you look back at the 100-year pattern, which is effectively this whole decade, it was one heck of a bull market that culminated on the 3rd of September, 1929. So what we're really saying is that this is a correction in the 100-year cycle, and it's not a crash per se, it's a pullback. Bear that in mind when you attempt to synthesize all this information. Now, 1923, let's head back to one repetition here, 1873. And what we see here is a significant panic. It's down 20%. Actually, that was just in America. This was the J. Cook bankruptcy, another railroad panic. And it was also coincided with the Coinage Act coming in. So there was, whether silver should be added to the dollar and things like that. That was the United States of America. Exactly 150 years ago, today, 9th of May, 1873, in Vienna, Austria, there is a panic starts breaking out. The Austrian stock market collapses and spreads a contagion across Europe. So today is a trigger point day, okay, just in terms of cycles. And of course, these big cycles don't necessarily play out to the day. I mean, having said that, you saw how the 90-year cycle did. But what we're really saying is there is a cycle flavoring coming up towards a potential, I don't even want to say panic, but towards something happening. Now, let's go back. We're on the home run now. So if we go back 250 years from now, or 300 years from 2073, what we saw was in the year 1773, Britain has a major credit crisis, overexpansion of credit, cheap interest rates, everything's booming. The East India Company is a major commodity company, shipping around, imperialism's rife, and of course, Britain is a leading power. Britannia rules the waves. But what happens is that this credit finally booms and busts, and this spreads across. It goes up to Scotland, which is a separate nation with a strong industry at the time, and the Dutch Republic. So you have to remember, the Dutch were a very prominent shipping nation at this time. And of course, 1773 sees the sort of thing that Brits love, tea parties, but they didn't like this one because it was in Boston. The Boston Tea Party takes place and accelerates the path for the United States towards independence, well, for the states to unite into independence. So that was 300 years ago. So that suggests, that there's some pretty important super long-term cycles coming together. Now, these cycles are coming together, and what we've done is that we've used the 150-year pattern to backtest from a future point, and that was projected using the 72-year cycle. But also, remember, we looked at 2007 as being, part of the 150-year cycle, 1807, 1907, 2007. Let's add the half cycle to 2007. That takes us to 2057. And just to complicate things and add a bit more fun to it all, we can subtract the beautiful Fibonacci number of 34, and that also gives us 2023. So yes, we are in a window for a potential panic, but we are literally that. We are in a window. It doesn't mean it's going to happen. So how do we capitalize on this? We zoom into smaller cycles, and I just want to share this with you to show you how we can zone this down. These are smaller cycles, completely different derivation, quite complex and outside the scope of what we're talking about here. But the long and short of it is where these cycles peak, and these cycles are known in advance, as you'll see, we tend to see significant trend changes in the market. And this cycle here has a significant date, a strong date for the week ending 30th of June, 2023. So we want to mark that date into our diaries. Now, I'm not going to say this is going to be a high or if it's going to be a low. I don't know. The truth is nobody knows. And honestly, I've been looking at this long enough, more than 30 years, and nobody I know can forecast markets. But we can get an incremental edge, right? We can get gains. So what are we going to do? What we know is that if a market is trending either up or down into the end of June, there is likely to be a potential reversal. So from a trading portfolio management perspective, you start looking at protecting that position, whether it's long into that window or short into that window, because we can prepare for a reversal. So that's the first one. And the other one I want to share with you is the last week of September 2023. Now, when we look at regular annual cycles, we tend to see sell-offs into into October, that sort of area like that. So we want to mark those in our diaries, those 2 time windows, but we can take this a stage further, and we can fine-tune these into daily cycles. Now, these are already cooking quite nicely, and what I noticed when I was preparing for this, that there is actually a very strong daily cycle coming here. Again, you can see how these have coincided with peaks and troughs. The 28th to 30th of June itself is a strong window. Now, why is this important? It's because it's overlapping with a medium-term cycle. So what I'm really saying to you is that we really want to be looking at the last week of June, and specifically the date window, 28th to 30th of June. So that's that. Is there going to be a crash? And the honest answer is, I don't know. What is the smart money doing? So we look at the commitment of traders data, and here is the latest data in our platform that we're able to analyze. And we see that actually the smart money, the commercials are actually long, the S&P futures. Now, that generally doesn't associate with a crash because they already know about the banking crisis. They already know about this stuff. Yes, there's always a geopolitical sudden threat, and that can always impact markets. But right now, this data is saying that the chance at this moment in time, the threat of a crash is minimal. So, we continue to monitor that on a weekly basis. So basically, let's wrap it up. Forewarned is forearmed. Anything can happen. Be prepared. We are in a window for a potential crisis, but if we have a look, the COT data is suggesting that the upside is stronger. We have turning points around about the end of end of June and the end of September, and that's it. That's incremental knowledge. And the truth is, I don't know what the market's going to do, but I do know how we can play it safely. So be prepared. And whenever you hear this time it's different, you know that it never is, because history repeats with absolute mathematical precision. So that's it, folks. Thank you.
Thank you very much, Andy. Always impressive in terms of the mathematical precision of cycles, and in particular, the approach that you apply. I'll give you a moment to maybe grab a glass of water just to squeeze in these questions in the time that we have. Audio clear?
Ron, sorry, can you hear me okay?
Yep.
Sorry, just the sound cut out there.
Absolutely fine.
Right, sorry, just say again, please.
Yeah, brief on-point questions. Audience keen to get these answered in the time that we have. The first one is just a brief word from yourself about history, repetition versus rhyme. Is it one or the other? Can it vary?
It can vary. And, we look there at resonance on those cycles. So the obvious example that I've shown you is 1957 was not a crash per se. It was just a bull market because the industries had exhausted themselves. Whereas 100 years before that, 1857 was a massive collapse and so on. So there's a degree of repetition. The commonality is that there was a top and sell-off, but one was more severe and the other was just more subtle, if that makes sense. So yeah, arguably history rhymes more than it repeats, but I would argue that, it's the 9th of May, it's 150 years on exactly from the Vienna crash. But I haven't checked since we've been live. I don't expect a crash today. There's nothing to suggest a crash, but who knows?
Playing those probabilities and looking on the long end side, a question on the 100-year cycle that you highlight, and I've heard you, of course, feature this before, 1929 going into 2029, is there a higher probability, according to your work, for more risk?
Sorry, do you mean 2000?
The 100-year cycle from 1929.
Yeah. So undoubtedly, the biggest windows are going to be the biggest risk window is going to be towards the back end of this decade, I would say. I think if we see anything now, it's going to be more of a correction or a pullback. And there are other factors that align with the back end of this decade, and we might not even go as far as 2029. I think that we really want to be on alert from 2027 because other cycles are coming together at that point.
Thank you. And just finally, cross-asset, dollar and commodities, what do your cycles suggest on those?
So basically, long commodities, okay? Now, the dollar is still the best house in a bad neighborhood of inflated currencies by central bankers. But, you know, we've now seen more stress on the euro. I do think, and I have written quite a significant piece in the last few weeks about the yuan, the BRICS currencies, etc., challenging, especially as we move towards, move away from the petrodollar into oil being traded in Shanghai, etc. So I still think the dollar's reasonably strong, but for commodities to head up, then there's a mix going on there. The long and short of it, I'm seeing significant commodity cycles coming together in June at the same time as I'm saying, and the commodity cycles are very strong for June. So I'm expecting big pivots in various commodities and therefore the dollar basically next month, basically.
Thank you very much, Andy Pancholi. And building on to our next speaker, Jake Bernstein, who will be speaking about cycles, seasonality, and protective strategies. Jake Bernstein has been publishing Jake Bernstein's weekly futures trading letter since 1972 and trading futures and stocks since 1968. His forecasts and opinions are quoted regularly in financial press and on financial websites, including Wall Street Week, CNBC, JAG, FN TV, and webtv.com. Bernstein is a consultant for investors, traders, industry, financial institutions, brokerage firms, and commercial firms. Traders, money managers, and hedgers, both new and experienced, subscribe to his market advisory services. Jake, welcome to the FSC Financial Crisis Forum.
Thank you, Ron. Just give me a moment to get my slides up here, okay?
Take your time.
So do you see my slideshow now full screen?
Yes, it's full screen now, Jake.
Okay, very good. Just one moment and I'll get started here. So thank you very much for inviting me to speak today. It's my privilege and my honor to speak and to show my work. I started trading about 52 years ago, and I started using cycles and seasonals about 47 years ago. So my approach is very different than my very educated and scholarly colleagues here. I may say things that are different than what they told you, but my work is very specific in terms of what I do. Not sophisticated. I don't use digital signal processing. I simply use cycles that are easily observable and easily findable. And all of the tools that Lars showed you, for example, are phenomenal and can only make my work better. But if I say things to you today that don't necessarily agree with what's come before me, well, that's just the way it is. So I'm going to tell you what my cycles are saying right now, taking into account the fact that Edward R. Dewey, the father of cycles, said that cycles are the mysterious forces that trigger events. We have some of those mysterious forces at work right now and the events that go along with them. So when I think about crisis, I think about change. When I think about change and crisis, I think about opportunity. So I don't segment my work into bull market, bear market, overbought, oversold, crisis, inflation, deflation, recession. Those are distractions for me. I simply think about opportunity. And I believe that if your opportunity is correct and your timing is correct, you have the solution to the problem and you don't need to think about recession and inflation and so forth. So let me be more specific about that. First, I'll show you the usual disclaimer, and then we'll go on to the work. I use 3 to 4 specific tools in my work. And let's take this, for example, chart of euro-dollar interest rate futures, not to be confused with the European currency, but rather euro-dollar short-term interest rate futures, similar to the 91-day T-bill. So I have here on the top of the chart the price. This is a longer-term chart, as you can see, and it is a monthly chart, I believe. Yes, it is a monthly chart. And I have several pieces of information here. I have the cyclical component right over here. I have the price right over here. I have in the middle of the chart, commitment of traders, net long positions by commercials. And I have on the bottom of the screen a very important piece of information, small trader sentiment. I use this combination to project my cyclical patterns and my highs and lows and my trends. But it's part of a process that I call setup, trigger, and follow through. Let me show you what I mean. Because for me, the cycle is only one component. Everything I do is based on this model, setup, which is a pattern. Cycles are patterns. There are literally thousands of patterns in the markets. The good news, there are thousands of patterns. The bad news, most of them don't work. They have no predictive validity. So the challenge for most traders is to find patterns that have predictive ability, predictive validity, and go forward with those patterns. Once we have a pattern, the pattern must be triggered. In other words, it's okay to say we're due for a cyclical low or a cyclical high, but we need a trigger that says, yes, the probability of that pattern developing this time is very high. Once we have those two elements in place, we go through follow through, which is 3 elements. Where am I right? In other words, my profit target. Where am I wrong? In other words, my stop loss, my risk. And 3, how can I maximize my profit? So let's go back to this most interesting, fascinating chart, the previous slide. So here we have it. Because this is futures, as price moves down, interest rates are moving up. As price moves up in futures, interest rates are moving down. They approach a theoretical limit of 100 on the chart, which is 0%. So let's take a look at this amazing chart. Look at the count. 1, 2, 3, 4, 5, approximately 6 years from one low to the next. The exact cycle repeated numerous times, almost perfect to its low or high without any digital signal processing, without any adjustment whatsoever. Simple fact of the matter. Not perfect, not symmetrical, but incredibly informative. And what the cycle says right now is this. We saw a top in the cyclical pattern right over here, which meant interest rates bottoming. We saw interest rates go significantly higher and futures go significantly lower as the Federal Reserve started to raise rates to, quote unquote, slow inflation. The projection of this cycle on a perfect situation, 1, 2, 3, 4, 5, 6 year cycle, is for late this year. Given the fact that interest rates are due to bottom short term late this year, we can expect futures to continue generally lower, or we can expect the Federal Reserve to continue either no action or pressure to the downside, in other words, by raising rates. But in any event, we are prepared for a significant low in interest rates, which is likely to bring the market higher. Looking at the chart over here, commercial activity, or as Andy referred to them, the big traders. Commercials have been buying futures. Why are they buying futures? I guarantee you not for their health, but rather for the expectation that interest rates will continue to stop going down and begin a move up on futures, which means lower rates. So they're loading the boat, accumulating investment positions, just as they did at this low, just as they did at this low, and just as they did at this low, and just as they did in advance of this low. So the bottom line here is short-term interest rates are bottoming and will likely make a significant bottom by the end of this year if they have not already done so. What do we have at the bottom of the screen? At the bottom of the screen, we have small trader sentiment. The market sentiment of that group of traders most likely to lose their money, most likely to be wrong at market terms. Note the juxtaposition. as the large trader is accumulating long positions at the cyclical low or ahead of the cyclical low, the small trader is 80% negative, saying, no, this market has not bottomed yet. It's going to go lower. We have that same situation now. The cycle is bottoming. The large commercial trader is buying, and the small trader has been extremely negative, looking for rates to continue higher. So that is the entire picture in terms of the setup. All we need now is a timing trigger to turn us bullish on futures, which have many, many significant implications for the stock market in general. Let me go to another one for you. So we went through this process right over here, and we're going to look at another one. I'm a equal opportunity trader. I will trade anything that moves. So let me show you how this all hangs together. Cocoa futures, a beautiful cycle, not perfect by any means, but because of the imperfection of cycles, we need timing. Notice the relationship. Notice that we projected many, many months ago a bottom in cocoa futures right over here. In advance of that bottom, there was a small amount of buying by commercial traders, as it was over here and here and here in advance and here as well. So you notice the consistency of large speculators accumulating long positions at cyclical lows and the small trader being most negative as they were right over here at the bottom. So that's how the work hangs together. We take that information, and fortunately there's an ETF for cocoa. It's called NIB. We look at our timing triggers chart, which triggered a buy in cocoa futures right around here. And you'll notice what has happened since then. The market has moved up. So we have the process entirely from beginning to end, from setup, which is the cycle, to trigger, which is timing, to follow through, which is profit target. I'm going to run through a few other opportunities that are developing right now, some of which are highly significant. So I'm not going to talk crash or no crash. I'm simply going to talk about what I see in terms of the cyclical behavior and the historical relationships and accuracy of those cyclical relationships. Let me show you what I mean. Let's talk about the 30-year bond market. Again, the cycle right over here, not perfect, as you can see, not symmetrical, but correlated with commercial activity and small trader sentiment, due for a low in the first quarter of this year, preceded by commercial buying activity and preceded by small trader very negative. So all the elements here are in place for this market to bottom, meaning simply this: interest rates topping and coming back down again. Now, obviously, given the fact that we can only go to zero or maybe even negative sometimes, the fact of the matter is we can't expect rates to come down a great deal because they haven't gone up a great deal, other than relatively speaking. But the picture looks very good to me in terms of a bottom in the cyclical behavior of the 30-year bond, the 5-year note, the 3-year note, and the 10-year note. All of this very significant. So does it answer the question, what will the Federal Reserve do? Easily, they could replace the entire Federal Reserve with the 5-year cycle and the 6-year cycle and save a lot of money on the budget deficit and be more right than they've been. Let's look at another chart. The 10-year note. Again, here's the cycle right over here. It's not perfect. It's not symmetrical, but combined with timing, example, cyclical low due right here, small trader very negative here. Cyclical low due right now, small trader very negative, and look at the size of this commercial buying activity. Who are those commercials? Sovereign wealth funds, mutual funds, insurance companies, large hedgers, hedge funds, and so forth, all combining here to give us a projected substantial, significant cyclical low in 10-year notes. Let's go to the next slide. Gold. Interestingly enough, in gold, there hasn't been any significant commercial buying activity since all the way back here in the year 2000. This is my long-term gold cycle. Again, not perfect, not symmetrical, but projected to bottom right here, and then finally showing a substantial low and a move to challenge all-time highs, which is what we've been expecting for a number of years. You will also observe here at the bottom, the small trader was the most negative since 2018, which correlated as a leading indicator to this big bull market we're seeing right now in gold, destined for new all-time highs. You can't see it on the chart, but there was a small amount of commercial buying activity right over here. But again, it was so small, not significant, but it was the first buying activity that we have seen in gold in many years. And why would commercials be buying gold? Several reasons. The first and foremost is they don't have enough of it on hand and need the constant available supply for their operations, either in manufacturing or otherwise. Let's go to the next slide. I'm trying very hard not to take more than my allotted time, which is why I'm rushing through this. Next slide. Platinum. Big bull market happening in platinum right now, completely consistent with the cyclical behavior. Our projected top many years ago was this level right here, and we're going to see that level most likely in the next 6 to 8 months. Big bull market happening in platinum. There has been no commercial buying activity, unfortunately, because I do like to see that support for the market to give us projections to the upside. When I show you the palladium chart, you'll be very flabbergasted by what you see, because I am too. Let's take a look at another one. Stock index futures, S&P. And Andy mentioned this just recently in his presentation. I want you to look at the correlation here. It's a 1, 2, 3, 4, 5, 6, 7.5 year cycle. Again, I reiterate, not perfect, not symmetrical, but very interesting in terms of the combination of events. Example, cyclical low due right here. The largest commercial buying activity we have seen in years, if not ever. And the small trader, the most negative since 2009. Combine these factors without any external fundamentals, and you have the makings of a big bull market. So I'm going to go on record as saying we have most likely bottomed. If there is negative news, it will be a buying opportunity. And I think the market goes on from here to make new all-time highs in a big bull market that should last 4 to 5 years at the very minimum. But I reserve judgment on that based on timing. But the most important combination is this right over here, the cyclical low, the record buying by commercial traders, and the lowest low in small trader sentiment since 2008, 2009. Very significant development, reflected furthermore in the NASDAQ, as you can see, cyclical low as well. Not perfect in terms of cycles, and I leave it up to Lars to fine tune these. He does a much better job at this than I do. But again, I use a combination of elements that have been proven correct over time. Small trader sentiment, very negative. Commercial buying activity, and a cyclical low. Very beautiful combination. Let me show you another one. Palladium. Now sit back and look at this chart for just a moment. Truly one of the most phenomenal things I have ever seen. And believe me, I've been around for a long time. Not only are we due later this year or early next year for a cyclical low, but most important of all, I want you to look at this right over here. This is the longest, largest commercial buying activity we have ever seen in palladium. Why would that be the case? Why would it be the case that the small trader would be the most negative they've been since here? Why would that be the case? Let's talk briefly about the fundamentals of palladium, which I don't prefer to do, but I will say it this time because it's very interesting. The way cycles are the mysterious forces that trigger events. The event is, I'm going to talk about that momentarily, but here's the mysterious force that says that by July, August of this year, the low should be in place. Commercial buying activity has been massive and unrelenting for several years. Why are commercials buying palladium? Who are these commercials? These commercials are manufacturers who need palladium for their various processes, electronics, automobiles, and so forth. And what's the real story here is the fundamental story, which I, as I said before, prefer not to get into, but in this case, it's very obvious. The world's largest supplier of palladium, in fact, probably 90% of the world's palladium or more, comes from Russia. And certainly in the past, they have used their palladium manufacturing as a weapon to cut off the strategic availability of this commodity. And many manufacturers are concerned about this happening again. Given the situation in Ukraine, commercials are buying palladium taking the liver and palladium for the specific purpose of having what they need when they need it in the event that the market is cut off from supply. And you'll notice how the cycle fits into that perfectly, or as Dewey said, the mysterious forces that trigger events. A few more charts. Crude oil. Crude oil has had a beautiful cyclical behavior as well, and bottomed right over here without commercial buying activity, without small trader sentiment. So as you can see, these elements don't always occur. Nothing is always in trading and investing, but we are still only partway through the cyclical pattern. So we still have higher to go in crude oil, meaning this: I will go to my seasonal work and my shorter term work and find the cyclical components that will bottom in the very near future, such as the leading indicator, which is the collapse in recent days, the recent weeks, leading to an opportunity to buy crude oil for another push to the upside. That's my projection there. And does it work in other markets as well? Soybeans, we have two cycles in soybeans. The bigger cycle right over here, which preceded this record move, and the half cycle, both of which bottomed right over here. And again, massive commercial buying activity accompanied this market or preceded the bottom over here, but recently we have none. Meaning what? Meaning commercials have significant amount of supply. They don't need to go to the market to hedge their supply. I'm almost done, folks. You'll be rid of me shortly. US dollar index. Check it out. Again, in advance of the cyclical low in the US dollar index, large commercial buying activity, small trader sentiment negative. Prior to the peak, small trader, the highest they bid in a number of years, again correlating as a leading indicator to the top. And therefore, this cycle in the US dollar remains down. And how about this? Japanese yen versus the US dollar. A beautiful cycle, almost perfect in terms of time, due for a major low right now, correlating with commercial buying activity, correlating with negative small trader sentiment, a perfect combination. Setup, we need a trigger. The trigger, there are a number of them: divergence, moving average channel, other indicators that I've developed over time to give me the timing to get into this trade. Almost done, Ron, almost done. And the British pound, the 8.1-year cycle, which has been in existence since 1952, also pointing to a low, but not this year, not until next year. So if you need to reach me, if you have questions, you can reach me at this email address, and Ron, I will take questions if there are any right now. Ron, you're muted. You're muted, Ron.
Thank you, Jake. Always on point and actionable, plus diverse in terms of the market review. First question I wanted to ask, Jake, is to position this question that we have for the forum in terms of near miss or storm ahead. Some have been aligning that with a down view for the equity market or risk assets in general. To be clear, your view is potentially looking the other way during the summer?
I think the storm is over. If there is a further storm, I would use that as a buying opportunity. I believe what is happening now is much ado about nothing. The upward course is very clear to me. But of course, I still need a further timing trigger, but I can't be bearish at this point in terms of the cycle.
Building on the diversity of views here that is being shared as part of the FSC team views, and on that point, Jake, currencies, because I could see that was a top setup, looking at the dollar, but more so on the yen.
Yes, here's the Japanese yen. I believe the yen has made its low and destined for much higher prices. This combination is as close to a sure thing combination as I've ever seen. The cyclical low, commercial buying activity, and small trader very negative. The small trader was the most negative they have been since 2001, which speaks volumes to me.
Thank you very much, Jake.
Thank you, Ron. Any other questions for me?
We'll hold until the panel discussion.
Very good. I'll be here. Thank you,
you.
everyone. Thanks for the opportunity.
And over to our next speaker, Dr. Richard Smith. I'm just quickly sharing the slide over. Just one moment. who will be speaking about how to prepare for market volatility, key insights from Dr. Richard Smith, a financial technology pioneer, founder of Finiac, a risk management app for retail investors, and author of Risk Rituals, a weekly newsletter evangelizing risk management, which I believe Richard will be speaking about today in terms of the importance of it. As the former CEO and founder, he grew trading stocks to more than 30,000 retail investors who entrusted his technology with a staggering 20 billion. He's been featured in Business Insider, MarketWatch, Forbes, and many other media platforms. Richard, wonderful to welcome you. Share key insights on this big question about a banking crisis near miss or storm ahead.
Thank you, Ron. Can you hear me okay?
Yes, loud and clear.
Great. I'm going to start sharing my screen. It is great to be here and really great to hear from everybody. You know, I asked for this event, suggested it because I wanted to hear from everybody. And I do think that, you know, we are clearly in a crisis right now, and everybody's got difficult decisions to make. And so it's exciting for me to be here with the other leaders of the Foundation for the Study of Cycles to share our best insights. And we didn't coordinate on this. This is about sharing with you our research independently and then putting our heads together with you and being prepared as possible. So can you see my screen okay? Got my slides? Okay, great.
All clear, Richard.
So I'm not going to actually be talking about market volatility that much. I'm going to share with you my views about this financial crisis, where we are in it, what it is, and where it's going. So just to start us off, the simplest explanation of what's wrong with the banks, right? Why are we having banks go out of business? Why are we having a run on banks? This is a chart showing the 10-year yield on the US Treasuries minus the 3-year yield. Okay, so what you get if you buy a 10-year bond minus what you get if you buy a 3-year bond. Normally, when you buy a longer bond, you expect to get more interest than if you buy a short-term bond. And what we have right now is this situation over here, right, where that yield has gone, the difference between these two yields has gone negative. So banks are borrowing short-term deposits from their depositors, trying to pay as little interest as possible, and then, you know, lending that money out for higher, longer-term rates. So banks are borrowing short and lending long. That works great when long-term rates are higher than short-term rates, but that's not what we have. We have an almost negative 2%. So 3-month T-bills are paying about 5%, 5+%, and 10 years are paying, you know, 3.5% right now. And that is a really bad situation for banks, especially banks that locked in long-term rates when they were very, very low. So that's the situation with banks. They're out of balance. And the question is, you know, is this over, or is there more pain to come? And have the banks that have gone out of business just been anomalies, or is this something that's likely to be more systemic and industry-wide? All right, so just a brief stop at big picture. This is a chart that I shared back in January of 10-year yields going back to the Constitution in 1787 in the United States. You know, a big 85-year cycle, which I believe has bottomed, and we now have this breaking of this massive downtrend that happened from 1982 into 2018 or so. And so I really believe that this is a sea change, that the markets and market participants have been very accustomed to this 40-year decline in interest rates, and it's a whole new ball game to have interest rates rising. And I think it's just the beginning of a couple of decades of rising rates, which is going to involve a lot of restructuring. We pushed rates down to zero almost, on 10-year yields during the last crisis, and that was unprecedented. I believe this is kind of like pushing a beach ball, down below the surface of the ocean, and that ball has to pop back up higher than it would have if it hadn't been forced underwater. So I think that is the big thing that's in play. I also just want to give a shout out to Ray Dalio. I think he's been doing great work in cycles. Appreciate all the work he's been doing to bring attention to cycles. And this is his view of a long-term cycle he says is typically 75 years plus or minus 25. So my cycle was 85 years. I'm saying we're kind of at the late stage of that cycle. And then this is a short-term 7 to 8 year business cycle or debt cycle. And as these accumulate, this longer term cycle gets longer in the tooth. He says that right now, we're at risk of a significant correction. Maybe this is the 90-year anniversary of the stock market crash. We'll see. I don't rule it out. I can't rule it out. I do think there are serious systemic issues, 3 big drivers that Dalio brings attention to. The government's financing itself in a big way by borrowing a lot and printing a lot of money. Everybody knows that. And we've got big conflicts within the United States prompted by the largest wealth and values gaps in our lifetimes. We're very divided. Hard to see how this country comes together and to reach new levels of productivity and cooperation. And then finally, conflicts between countries, you've got China on the rise, India on the rise, et cetera, and the United States is being challenged. So I do think all of these things are in play. And I do think that these are things that we do need to be attentive to, not, run and hide under our mattresses or be overly stressed about it. But to me, they're not out of the question, and they're more probable today than they've been in my lifetime. All right. And then finally, not finally, but the big thing that I see is what I'm calling artificial wealth. So we've heard a lot about artificial intelligence lately. By the way, I asked ChatGPT, what's the difference between art and artifice? And ChatGPT said, art is generally associated with creative expression, while artifice is connected with deceit and manipulation. And I do think that for the last 20 years from the Federal Reserve, we have seen deceit and manipulation, and from politicians in general. And I think that that deceit and manipulation has created a false sense of wealth that is going to we're going to have to adjust to that. So this was a insight from Ben Hunt over at Epsilon Theory, looking at the total wealth that households control in the United States versus our GDP, how productive we've been. And you can see that here, starting in 1983 or so, GDP kind of started to get a little more horizontal, a little less vertical, while wealth, household wealth, continued going up, and you got a bigger gap between these two than we've had traditionally in the past. So we've felt wealthier than our productivity has warranted. Bottom line, how do you do that? You do it by lowering interest rates, driving interest rates down to zero, et cetera. So this is a ratio of those two. When you take our net worth in the United States and divide it by our productivity, our net worth has reached peaks over 6 times our productivity, whereas the average has been, below 4. And when did this start happening? Started happening, especially around, after 9/11, early 2000s, Alan Greenspan, et cetera. Prolonging the lower interest rates longer than they should have been to address crisis after crisis after crisis. So that went off the rails even more after our last crisis. And what's going to happen at the next crisis? I don't think we have a very deep bench right now that can address the next crisis. And there's plenty of crises that certainly could come. Just to show, these are the 10-year yields here in blue. Okay. So peaking in 82, going down all the way to, 2019 or so. And this over here is the wealth to GDP. We've got wealth 6 times productivity, while interest rates are finally pushed down, below 1% on 10-year yields. That's crazy. So look, especially here, around when you get up above 4 times GDP, all of this came from, I think, interest rates, long-term interest rates being held lower than they should have been for longer, creating this artificial wealth. And that is got to change. And it started to change. Okay. So this isn't going to happen all in one whoosh, I hope. It's not out of the question, but there's definitely adjustments and readjustments and corrections coming and to be made. Yeah, this is what I call artificial wealth. All right. So that is what I believe the big picture is. And the question is now timing. So I'm going to actually jump over to some charts over here. And these are right out of the Foundation's cycle analyzer. See, somebody sent me a message. Let me make sure I'm not missing anything. Okay, good. So this is a chart of 10-year yields on US Treasuries. Okay. Right now, 10-year yields are showing a top on this most prominent cycle. Okay, this is a 66-week cycle, which means yields should start coming down. Not inconsistent with what Jake showed. It's interesting to me that almost all of the cycles detected by the cycle analyzer on 10-year yields are red, are bearish. So I do think that, in the short term, we should expect 10-year yields to come down some more. Meanwhile, it's not just 10-year yields coming down that's going to save the banks. It's the spread between the longer-term yields and the shorter-term yields. Okay, so let's take a look at the 3-month yields. 3-month yields have a lot more, a little more bullishness into October. Cycles can be off, plus or minus 10%, but I think short-term interest rates are still likely to head up some more, whereas longer-term interest rates are likely to start going down. That puts more pressure on banks than what we've already got. And by the way, here's the regional banking index, S&P regional banking index in the United States. We have a pretty nice cycle here of 205 weeks, and that cycle hasn't bottomed, showing a bottom in the fall or even early 2024. So I continue to believe that we are likely to see more pressure on the banks. I don't believe the stock market can really take off while the banks are still struggling. I do believe that once we do see, once the next shoe does drop, a lot of the charts I've seen today have shown, in August to October, time frame. Maybe we'll have an October crash. That's oftentimes a common time for something like this to happen. So do I know it's going to happen? No. Do I believe it's going to happen? There's a high enough probability to me that it could happen that I'm taking defensive measures. My 10-year money, it's in the markets, no worries, long term. But for any short-term money that I need in the next, 12 to 24 months, I am not putting all of that at risk in the markets right now. A couple other charts. Let's see. Oh, here's the the CPI does show inflation potentially coming down some more, having peaked. And another interesting chart, this, M2 year-over-year growth has gone negative. Bill Sarubi showed this for the first time since in 90 years, I believe. So M2 is our most easily accessed money, what's in our checking accounts, our savings accounts, et cetera. And that is become, less and less accessible. That's less liquidity for the stock market. I think this contributes to the risk of the stock market correcting. And I will just end here with a few of my cycles on the stock market that I showed back in January. This is the E-mini S&P, or just the S&P 500. The longer term cycle, 7.5, 8 years, I believe is down. And let me get to the next tab here, if I can get this thing out of the way. And then this is the shorter term cycle, the famous, just shy of 3.5, 4 year cycle, bottoming potentially in the near term, right? But again, 10% could be September, October. So that's what I'm seeing. I see continued risk. I think short-term rates are likely to continue rising. I think inflation is going to be harder to get back in the bottle. And I think longer-term rates are due to start falling. So that's going to put more pressure on banks. We're coming out of this massive, 40-year decline in interest rates that was artificially sustained by the Federal Reserve to drive them even lower. That created a sense of artificial wealth for us that is going to take an adjustment process. And finally, the last chart, I was surprised by this. I look around, the thing I'm most bullish on right now, cycles wise, is Bitcoin. And it's interesting because Bitcoin to me is kind of an anti-bank bet. And we've certainly seen Bitcoin flourish during the banking crisis. And I do think that banks in general are in crisis. I think banks have gotten very comfortable. I think bankers have ruled the world for too long now. And I think that the confidence in the banking system is waning. And so I think that bodes well for Bitcoin. So I will leave it at that until we get to the roundtable. Thank you.
Thank you, Richard. Thoughtful insights and holding questions until that panel discussion. And I'll segue on to the final presentation. Thank you.
Excellent. Thank you.
So key insights on the roadmap and gold's crisis hedge. My focus is market strategy and education mentoring, serving as part of the independent research advisory of RWA. And I do lots of industry work with groups like the Foundation of Study of Cycles, but then also the International Federation of Technical Analysis. So the key agenda for today is roadmap cycle, historical echo rhyme of the banking crisis. So touching on some of the points that our team have already highlighted in a visual slide, cycle risk projection based on the roadmap framework that I've used for some years now originally adopted from mentor Robin Griffiths, suggesting further risk into the second half of this year, although interesting to see some of the variations in terms of summer period versus year end, speaking with my colleague there, Lars, and then Jake as well, taking the other side of the view. S&P 500 key level at 4,200, some points to highlight there as to why that matters, and some interesting price and time divergences that have shown up, which seem to be realigning for now. On the market internal side, this theme of fire and ice tech has clearly been the strong driver year to date, ironically, given that it was the laggard last year. And of course, the ice cooling of banking sector, particularly on the regional side, that my colleague, Dr. Richard Smith, was just highlighting now. And then finally, macro risk ahead of the US debt ceiling. We had that question chime in from our audience. I will just touch on this just as an interesting event risk to keep in mind. Keep in mind what Jake Bernstein said about the work of Edward Dewey. It's the mysterious force that triggers events. We don't know what those events might be, but certainly 1 month out from now, we know that X date is around the corner. And then finally, looking at what all of that means in terms of sentiment, and most importantly, gold. I'll fast track through gold. You will be able to see more of that analysis in the next FSC blog. Okay, so the roadmap cycle is built on a blended approach, macro fundamentals and technicals, but it's ultimately driven by cycles and trend ranking models. If you would like to learn more, feel free to read the book, Mapping the Cycle, co-authored by my mentor, Robin Griffiths. From a market cycle perspective, it's a behavioral fractal model, risk on during the boom phase and risk off in the aftermath. It continues to signal late stage to recession, but of course, market timing will be key. Depends on which part of the world or even asset class we're looking at. But this is generally risk portfolio and the United States as a case in point, suggesting we're between W, X, and Y with the final rollover ahead. Now, the actual rotation of the model, looking at the blend of macro, fundamental, and technicals, suggests that we're late stage cycle into recession, marked by growth contraction with credit pressures to follow. On the valuation side, growth value rotation still in transition. It's been a very difficult one to call, especially yet to date with tech leading the way, but expect a long-term rotation ahead. Market internals on the technical side remain narrow, fragmented, and deteriorating. So caution there, if you are seeing things lead, how viable and sustainable is that trend? Always good to maybe look at the equal weighted indices to get a truer picture of market sentiment. And then finally, when we look at the bottom of the table for potential asset allocation decisions, i.e. what do we do with our portfolio, think of a barbell strategy where we maintain risk asset selectivity, profit taking potentially, while building up defensive plays such as gold, cash, quality bonds, maybe on the short side, and non-correlated portfolio risk. Now, one way of doing that is looking at risk diversification in terms of macro themes. Think of Japan with their yield control, or China pro-growth cycle. Interesting chart there that Jake highlighted on the Japanese yen, and on China, I highlighted this in a previous presentation for the FSC last year, highlighting how their equity market was recovering from a long-term base. Now, the adapted cycle schema is basically the signature work based on originally on Joseph Schumpeter, later on borrowed by my mentor Robin Griffiths. But essentially, it influences global sentiment, policy, and markets. Each cycle is unique. When aligned, it creates that moment in time where ultimately big things happen. Now, just quickly, the K wave up top is what influences interest rates and social tensions. That has been generally positive and will likely continue structurally over the next few years, but not in a straight line. And of course, there are different seasons to the K wave. According to most analysis, we're potentially still in the winter phase where things continue to be volatile. On the jugular cycle, this is more the long business cycle, that also suggests further elevated volatility, but again, as part of a transition period. And the kitchen business cycle, which aligns better with the presidential cycle, is interesting in terms of the midterms as we approach the elections of 2024, policy does impact markets. And I shared some thoughts on that during a seasonality presentation last year with the foundation. And lastly, on that point of seasonality, Jake's your best person for that work with the in-depth knowledge and analysis. But according to my work, the sell in May could work again this year as it did last. Keep that in mind based on how risk markets move. So let's look at the historical echo rhyme of the banking crisis. So the key point here is over the last 100 years, there has been a historical echo rhyme. Circling back to team colleague Andy Pancholi, it also echoes with the 90th anniversary of the 1933 event risk, I believe, to the month of March, when the previous panic kicked off. You can see 1937 there on the chart at the far left. What we're looking at is the number of bank failures in addition to assets that were wiped out. So interesting benchmarks to keep in mind. The biggest in terms of bank failures was 1989 during the S&L crisis, but the larger footprint in terms of asset wipeout is actually 2008 and soon to be surpassed right here now, 2023. What's interesting is that there's a larger footprint now than in any other time in history. And that's partly down to systemic risk in terms of liquidity, clearly much higher, connectedness across the world, and then, of course, the leverage factor, which continues to be key. So you can see there on the chart, inflation-adjusted 3 banks equaling a much larger 24 banks in 2008 in terms of assets that were at risk. Now, key insights from 2 influencers, leading off with BlackRock CEO Larry Fink, who believes that it's too early to know how the widespread damage is. And I think that's prudent, thinking that maybe several of our team are already highlighting. Ray Dalio of Bridgewater Associates also believes the same, but he takes it a step further and highlights the fact that this banking crisis is probably one of many to come, as part of a canary in the coal mine. So he's focusing on the fallout from contractions in debt, credit markets. Look up his extensive work in this field, books which have been published all about the big debt cycle ahead. Now, while more banks are likely to fail, the predominant moderate narratives consider the threat as contained, not systemic risk leading to a financial crisis 2.0. As you can just see there in the narrative, rather than perform a forensic autopsy in the time that I have, I'm just going to focus on the implications in terms of sentiment and markets. So looking at cycle risk projection for the second half this year going into next year, this is a broad-based measure, medium to long term, so not a short-term timing that you've heard from some of my colleagues. The composite cycle work, which impacts global sentiment, looks at and correctly predicted the 2020 shock, that a shock would happen. Of course, the pandemic itself was a surprise to all, but also that it would be worse than the 2008 debacle. So that was interesting. So when we did think it was the end of the world in 2008, it wasn't according to this model, but things that was still ahead in the winter season of right here and now. The recovery period and the light at the end of the tunnel is supposed to be, according to this model, post-2024. Interesting to hear from my colleagues in terms of what they're thinking further down the line. But essentially, the stress points is 2023 into 2024. And that, interestingly, ties in with work that was published a long time ago by cycle pioneers Samuel Benner. I know this has been doing the rounds on social media in cycle audiences. We first featured this in the foundation events of last year. And one of the signals that seem to be in line with what's been happening is the 2023 shock prediction. And potentially the financial timetable originally attributed to W.D. Gann, where he highlighted 2024 as a big macro risk. So these are big, broad, long-term cycles. The short-term timing is something that we should maybe measure closer to the time. And circling back to what we heard right at the top there from Lars on the financial stress index, that remains elevated. But as you heard from him, potential peak in August with stabilization thereafter, question mark. Again, follow Lars on the YouTube channel of FSC for further short-term timing on that move. Now, what's interesting, if we look at sentiment indicators based on the conference board consumer confidence, this is a popular and actually very reliable, historically reliable indicator. This shows potential for recession ahead. Timing is just one of those things with these indicators because they do often lag. But right now, it is at an extreme measure when you look at it over time. Focusing on the S&P 500, the real price action, the stuff that impacts your P&L, we've been chopping up and down in a sideways range, but the risk level at 4,200 remains key. Now I'm sharing with you a static chart, but I encourage you to go back to your trading screens or your portfolios because this market has been a little bit wild. Essentially, 4,200 is a be-all end-all level. If we hold, then it suggests a failure and a potential multi-month reversal pattern that would likely hit the 200-day moving average, and then most importantly, the 3,800 level, which is the March panic low. These are probable moves that could happen if we fail below 4,200. If we don't, then I would suggest that you take the bull view for a big break up higher. Now, what's interesting is that the FSC cycle model based on digital signaling, as you heard us describe, has been flagging a price-time divergence for some time. Potentially, it's realigned depending on which way the market goes, and could also be reinforcing the negative seasonality pattern of sell and May, which I highlighted before. Watch this space to see what happens. But this is something that certainly I've been watching for further confirmation. Looking at the options market, we can see that the key levels are that I just highlighted, 4,200 and 3,800 are key. So that's where a lot of the price sentiment is built up. And so on the 4,200 is just where we are at the moment. 3,800 is the low side, the March panic low. And then focusing on market internals in terms of sector rotation, something I've been calling fire and ice. Tech is the fire that has been fueling this index level risk trade up year to date. This is the FANG index highlighting potential rollover. It's already a big part of the S&P 500 and NASDAQ move. You can see there on the chart, top right, figure 2, the red zone just highlighting how important it is. But just recently, we had some earnings pressure in line with expectations and some positive surprises here and there, but generally down trend quarter on quarter. So just keep in mind potential price exhaustion on FANG as a headwind on the S&P 500. If it doesn't do that and hold up, that would reinforce the uptrend. Now, the ice side of the fire and ice combination is, of course, the banking crisis, and maybe not the big banks, which seem to be too big to fail, and certainly backed up by policy. Regional banks are still landsliding lower. And I was very interested to see that chart that Dr. Richard Smith shared on the FSC model, showing that further downside risk from the timing perspective. You can see here, price pattern remains bearish, this reversal pattern, which achieved its price objective and may head down lower to the extreme lows. And of course, just recently, we had the deja vu experience with First Republic, echoing SVB, but then many others to follow in terms of what's been happening in the last few weeks. And then macro risk elevated ahead of the US debt ceiling. So just to touch on that point that was asked by our audience, the yield curve has been the one to watch. And certainly on the short end versus the long end, 3 months versus 10, it's had a wild extension to a 40-year record wide, and that shows more stress in the very near-term maturity and months ahead. That's showing up when you look at 3 month versus 1 month. So actually giving you a market timing without the cycles, but just using the risk indicators for literally the X date ahead, potentially in terms of the month of June and the debt ceiling that may follow. It chimes in also with the Fed that has finally acknowledged recession risk ahead, albeit mild. They're still pricing in 58% probability, but it's at an extreme 1982 high. So we're even seeing, the narrative of policy actually playing catch up with potential risks ahead. You could treat that as a contrarian signal or perhaps a confirmation. And then most importantly, what concerns concerns me a lot is the CDS, which is a very important stress sentiment indicator showing that we're back above 2008 financial crisis highs. Basically, this is the market's way of quantifying whether the US will default, and while they may or may not, and of course, either way, there'll be a backstop contingency plan, I'm sure, this at least shows that the sentiment is sky high and there is concern ahead. And then just to conclude on that, you can see that there has been a revision in rate expectations. So while most people did finally agree and understand that the Fed was going to hike rates as they have done for about a year now, they have flipped the other way, going against the base case of Chairman Powell, looking for a cut in September after we just had the quarter point rise just passed. And the thought here is potentially that the hand will be forced. Not that this is a choice, but the hand will be forced by market forces if and when we get further volatility. These are some ex-state forecasts from the big household firms. You can just see there for review post-session on video what the actual White House is suggesting if the debt ceiling is not met, and different scenarios of that in terms of the employment market and growth. And then final insights from another key influencer, Stanley Druckenmiller, who compares the debt ceiling and the fiscal spending to worrying about the whether a 30-foot wave will damage the pier when you know that there's a 200-foot tsunami just miles out. So he's concerned about bigger trouble ahead, other crisis events, not just banking and not just the debt ceiling. So I'll just close on this chart on gold, 2000 ceiling ahead, what next? There's a key resistance level there. Outperformance looking at cross assets, but it is losing momentum in the short term. If you look at gold across other currencies, it is still outperforming. And most interesting is you can see the blue line there is gold in dollar terms. So although the dollar has been down, which should be gold positive, it is actually the laggard. So if you look at gold across other currencies, this is more of a broad gold strength at all-time highs, and ultimately a fiat currency hedge. And you can see here multiple currencies underperforming gold. You can see the straight line going horizontally over time, and that ultimately is due to debt issues, which are at historic extremes right here and now. And what's interesting is that central banks are at generational optimisms in gold, and they've been buying a lot recently, partly due to the sovereign risk, which you can see here on the chart, also fueling gold higher. But my grand finale chart and final one is this one, showing an increase not just in central bank gold buying, but a drop in US treasuries. So some interesting diversification away from US assets for a variety of reasons. I'll stop on the final short-term chart, just showing that there might be an unwind from overbought conditions, which could be a buying opportunity. The cycles model based on the FSC analysis also confirms that, but gold sentiment in the short to medium term, I should say, is suggesting that there is accumulation ahead. And again, this could be a buying opportunity. That's it from me, key insights, and I pass it on to the panel to have an open floor discussion and to take questions. Richard, if you'd like to kick us off as FSC chairman, what's your top of mind thoughts, having reviewed everyone's ideas and some of the questions we've been getting from the community out there?
Yeah, I haven't been able to follow the questions that much because I've been following the speakers. I saw a fair amount of continuity. Overall, my sense is that we could be out of the woods, but probably not. You guys tell me if you agree. Or at least there's a decent probability of another leg down by the summer or early fall. Probably, some rally by the end of the year. Maybe Jake's right, and it's going to be sooner rather than later. The 4,200 level on the S&P probably is a good one to watch out for, although I have seen a lot of head faking going on in the markets. I don't know about anybody else, but seen a lot of washing and rinsing going on, you know, like false breakouts, false breakdowns. So I wouldn't be surprised to see it tested a bit and then go the other way. But overall, I saw a lot of agreement really across the presentations.
And a follow-up question from our audience, Richard, about whether you suspect the Fed has a goal to centralize deposits, so it may deploy CBDC.
I do think that's a potential issue. I really do think that the Fed has overstepped its bounds and is in a very tight spot, and you know, could lead to more attempts at financial controls. So I do think that's something that we should fight against if it does ever get on the table.
Thank you. And a question for Jake. What is your view on silver cycles? Does it correspond with palladium?
Yes, the silver cycle correlates very closely to gold, and silver is actually my second best pick next to palladium. But one thing I wanted to say about palladium, it's a treacherous market, especially in the futures. It can move $10,000 in one day. So the best bet there is PALL, the palladium ETF, or SPPP, that's Sierra Papa Papa Papa, the combination ETF for palladium and platinum. And I just want to say one more thing. My view on all of this is reductionist, by which I mean, if your timing is good, it's irrelevant whether we're in a bull market, a bear market, inflation, recession, and so forth. It's meaningless to me. Those are all just words if my timing is good. Sorry.
That's good. That's great. I'd also add, you know, what is it? Bulls can get rich and bears can get rich and pigs will get slaughtered.
Bulls make money, bears make money.
Right.
Right.
Follow-up question, Jake, on natural gas.
Yes.
I think it's saying thoughts on natural gas cycle, and as it has some very interesting daily and weekly views. So maybe a combination there between yourself, Jake, and Lars on natural gas.
Lars, you want to go first?
I highlighted a natural gas cycle some weeks ago on our channel, and I think some long and short-term cycles align on a current interesting low opportunity in natural gas. Time-wise, looks like prices anyhow on a historical low level anyhow. So cycle looks interesting for possible low here. Jake.
Agreed. I'm absolutely, Lars, good work. I'm waiting for a low in natural gas. The problem is we keep on waiting and waiting and waiting, and it goes lower and lower and lower, and commercials keep on buying and buying and buying. So we need a proper trigger, which has not happened yet on a daily. So I'm looking at the weekly chart for my trigger.
Yeah, that's right. I'm waiting for that trigger which should arrive, at least hopefully closely. But you're right, we need to monitor closely.
We will continue to wait for Godot until that trigger comes.
Well said. Ready and waiting. And circulating to Andy, a question also on commodities, but on a broader basis. Which commodities, when you were speaking about long, are you most bullish about?
I think wheat is the one that immediately springs to mind. We've got a combination of very strong time cycles aligning pretty much with seasonality. And then if you look at the commitment of traders data, there's some pretty strong factors there suggesting that wheat could be leading the way up very shortly.
I concur, Andy.
And I saw you did a social media post on wheat just recently.
Yes, actually today on LinkedIn, I popped that up there showing the specific cycles. So yeah, I mean, that is certainly one I'm very interested in. I think the grain complex generally is showing the potential for moving up. And in terms of the long-term cycles, if you care to look at the 50-year cycle that we talked about earlier, there's also a 49-year cycle, and specifically it's actually I think it's soybeans and wheat 48 years and 11 months, so it's 1 month short, and it's been working out absolutely precisely to within a couple of weeks. So Yeah, I mean, long range forecasting isn't easy, but they are suggesting that we really need to be aware. As I said, I think is going to be the leader in this. I think there could be a geopolitical threat to it, not just with what's going on in the Ukraine, which is a significant wheat producer, but then if we go back to the 90-year pattern very shortly, in fact, already we're in the 90-year pattern from the Dust Bowl cycle, which is something we haven't even talked about here. I tend to talk about it with my inner circle, but the Dust Bowl, really did wipe out the wheat and corn crops. Beans weren't so. Soybeans didn't start till trading until on futures markets till October 1936. But what happened is that since as America was pioneered and people were given the lots of land, the stakes, as it were, the stake. What happened by the time we got to the 1930s, the topsoil had been eroded badly, and therefore the crops were no longer sustainable. And that the topsoil was very loose, and as they got the winds coming in, for several years we got a decimation of the crops, and I think that cycle could well repeat.
Thank you for the the mysterious event that could happen again, the repetition or the rhyme even.
Right.
There's a question on Bitcoin and crypto in general. I'm steering towards Lars because you did a big presentation on this last time, but open question to the board. It's actually a question that's geared for anyone who has a view there. Richard, you also touched on Bitcoin and using the FSC cycle model. So anyone who'd like to speak about crypto, Lars, if you could lead, and Bitcoin and crypto in general.
There's a full video out there about 1 hour, so you're free to watch. But the summary is that we have approached from January to May, so was a good time. That was my summary at that point in time, to accumulate Bitcoin, because we could now see another upswing. So we need to see how it works out.
And Richard, that was confirming what you just shared with us.
Yes, exactly. Yep.
Thank you.
Good. Well, I think we should wrap it up soon.
Yep. Quick fire point questions on oil and India. Two separate questions, I might add. So if anyone has any ideas, to oil in terms of the view in generally, but also a few people talking about geopolitical event risk, and India just in terms of that global diversification. Any takers?
Well, the Indian stock market's looking quite bullish actually at the moment. I think there's a lot of bullish energy coming in there, but that's about the only thing I can say right now. I mean, I don't have the. I'm just looking at the chart pattern. I think that certainly suggests that we could be heading higher there.
I would say my long-term cycle in crude oil is still bullish for at least another 2 years. So I consider the recent sell-off as an opportunity in advance of a buying signal.
Thank you, Jake. I was just about to circle to you on oil because I recall you featured that chart. Okay, so a closing fire point question: banking crisis, near miss, or storm ahead?
I think there will always be storms ahead. It's just a question of what we do to protect ourselves from those storms.
I think that a storm ahead is more likely than not. And what I'm doing to protect against that is being very agile with my shorter term, 3 to 6 month, 12-month money.
I think that's more or less what we tried to see across different presentation. Anyone should not be surprised during the next months if there is another storm coming out there. But as always, once the storm passed and you are prepared, it's always a good opportunity, as Jake phrased it. So interesting time, because I think this summer will then show what's happening.
And I think we always have to minimize our regret, right? So if you got to put yourself in a position that if the market takes off from here, you got a piece of it. But if you get a better buying opportunity, you're happy to see that too.
And Andy, how about yourself?
Well, in terms of the S&P 500, I think you nailed it. This line in the sand at 4,200. I am favoring the bullish side, looking at what the commercial activity is doing. The time cycles, I know somebody asked the time points that I gave, are they highs or lows? And the truth is we don't know, but they are pivot points. So we know which way the market's going into them. So we'd expect reversals there. If we do get a sell-off, and I think we've already seen a reasonable sell-off already this year, we are really, I think we just look at the 100-year pattern, which saw, as I mentioned earlier, the lows in 1923 and then a move up in towards the back end of the decade, but also look at the 90-year pattern, which saw the low on, I think, the 7th of July, 1932, and then the market advanced from that point. That was the 29 crash low. So if we look at these super long-term cycles, the evidence is pointing towards a further move up. But then, as Richard said, the banks are under a lot of stress, and we do have a potential wild card of a crash. And the cycles I pointed out suggest that we are in a crash window as well. But whether it's just a small sharp crash or something bigger, I would suggest. I mean, let's look at the evidence. And those of you who've been watching the FSC channel, we had the incredible Bob Prechter on, showing his super long-term cycles where he pointed out a top for 2 years ago. And, we haven't taken, that still holds from January last year. So if there is a super cycle, what the non-believers call a black swan, then, maybe that's something that we've missed. But right now, the balance of the evidence suggests that we do. I would favor the upside more than the downside, but I want to see it manifest in the chart pattern first. And the other thing we have to think of, all this money's being created out of nowhere. Again, as Richard pointed out, I don't trust the central bankers either. So it's got to go somewhere. And if there's nowhere for it to go, generally tends to go into the stock market. So that makes it bullish as well.
Thank you.
Good. Well, I would just wrap up with a big thank you to all of the presenters. And I'm very proud to be able to offer this level of quality to the public through, for free. We're doing this for free on YouTube. So
thank you for your leadership, Richard.
Thank you, Jake. So it's been a really fantastic couple of hours, and I know everybody put a lot of heart and soul and time and energy into pulling this all together, including the people behind the scenes. So thank you all very, very much.
Thank you.
Thanks.